Welcome to Insights and Indicators. I'm Jason Thomas, Carlisle's Head of Global Research and Investment Strategy. And in this podcast, I share our observations and opinions on the economic landscape, as well as insights from research being conducted by our team here at Carlisle. This episode was recorded on January 14th, 2025, and the discussion reflects composite portfolio data and analysis of recent government reports that are accurate as of that date. Today, I'm discussing our 5 questions for 2025 report, which we released last week. This annual paper, which can be found at carlisle.com, along with other research and insights from the firm, is our effort to identify the macro issues likely to prove most consequential for investors over the next 12 months. And it also serves, in many ways, as an articulation of our research agenda for the year, the 5 areas where we'll devote most of our time, at least until new developments demand our attention. So the first question for 2025 that we seek an answer to is, are U.S. policy rates restrictive? And in the press conference that followed what has been described as a hawkish December FOMC meeting, Chair Powell again insisted that monetary policy remains, in his words, meaningfully restrictive. The use of this word restrictive made me think about The Princess Bride and the line that you keep using that word. I do not think it means what you think it means. And the idea of restrictive, you can think of first the meaning, but then also the function that it serves. In this case, the function is very obvious. Continually insisting that rates are restrictive is a way to signal to markets that interest rates are too high and interest rates are going to fall further. The meaning is a bit more complicated. Until the early 1990s, most analysts, most monetary economists really thought of restrictive policy in terms of the growth rate in the money supply. So a restrictive policy was one that slowed the growth of the money supply below the growth rate in real GDP or output. Beginning in the early 90s, the Greenspan Fed essentially decided to move away from this framework. They looked at the way that more households were keeping their savings in stocks, in bonds, and other financial instruments, and felt like the money supply, which is really just bank liabilities or checking deposits, savings deposits, deposits in money markets, really no longer captured the broader trends in prices or economic activity. And so what Greenspan came up with was just the idea that there was some equilibrium or neutral interest rate. And the goal of policy was to move the rates of interest controlled by the Fed, the money market interest rates, above or below this neutral rate in an effort to either stimulate activity if you keep the rate below its neutral level, or to constrain inflation, to have restrictive policy if you bring it above that level. The problem with this framework, of course, is that neutral or equilibrium rate cannot be observed. We're just sort of left guessing at what its level would be. And during that Greenspan era, 1987 to 2006, the neutral rate that one could infer from the behavior of monetary policy was extremely stable over time. The real rate was just over 2%. So, with a 2.5 or 3% inflation that persisted, that meant that over time, the Fed funds rate, short-term interest rates, would average about 5%. When you took them down to 3%, policy was stimulative. When you took it above that, policy was in a restrictive territory. Over the last 15 years, we've had 2 enormous shocks. The first, of course, the global financial crisis. In the years after 2008, we had a situation where policy that anyone would have expected at the time to be extremely stimulative did really nothing to incent demand or lead to upward pressure on prices or broader economic activity. And so it became clear that this neutral rate, to the extent it exists, had fallen quite substantially. Then we're now in a situation where the second shock of the pandemic, and not just the supply shock, not just the supply chain crisis that followed, but also it seems to have awoken a sense of pricing power, an eagerness of management teams in many cases to push on price, to take advantage of maybe temporary dislocations, to increase prices, and otherwise just arrange affairs, recognizing that price is now a very important variable for profit maximization. I think in many parts of the economy where that had not proven to be the case. In addition, since the pandemic, we've of course had this enormous increase in fixed investment in many areas in the industrial sector, data centers, electrification, batteries, EVs, etc., so that demand for capital seems to have increased this neutral rate. And then also we have much, much larger fiscal deficits, about 2.5 times larger than those that prevailed prior to the onset of the pandemic when you adjust for the state of the economy. So as a result of all this, it seems that we have a neutral rate today that may be back to where it was in this 1987 to 2006 Greenspan era. We'll see. Again, I think that's very much a question for 2025. But if you were to look at the last 2 years of data, and you see an economy that has grown at an average annual rate of nearly 3%, well above most forecasters' estimates of the economy's potential, you look at a core CPI inflation rate that continues to persist above 3%. And of course, you look at things like labor productivity growth, which has been running above a 2% annual rate for 5 consecutive quarters. And you really wonder what is restrictive about any of this. And of course, in financial markets, when you look at equity valuation ratios, credit spreads that are 17-year tights, these do not signal that, again, that policy, the stance of policy is restrictive, at least as it was originally understood when this framework was created. So again, we'll see 2025, perhaps things will change, but it could also be a year where I think that this rhetoric from the past is retired. The second question that we seek an answer to in 2025 is, what is the purpose of tariffs? I think we can all see that tariffs are coming, but we don't yet know what their purpose is. I think that this is very significant because, on the one hand, tariffs can be used as just a way to raise revenue. Congressional Budget Office estimates that tariff increases, very broad tariff increases of the sort President Trump discussed during the campaign, would raise about $2.7 trillion of revenue over the next decade, equal to 0.7% of GDP. This is not so unreasonable to look for revenue from this source, imports. The US, according to the WTO, has the lowest tariff rates in the world. The US is unique among its trading partners in that it does not have a border-adjusted value-added tax. And, so that's a lot of revenue in its own right. But of course, another priority of the administration is extending the tax cuts initially enacted in 2017. And the tariffs would, again, based on the CBO estimate of the broad proposal, would offset nearly 70% of the revenue lost from a 10-year extension of those tax cuts. So again, this, you can agree or disagree, but it's not so unreasonable to think that using imports as a new tax base to extend lower tax rates on income, it's again a reasonable approach. But secondly, the additional purpose of tariffs has been a suggestion that they could facilitate reindustrialization. And in that use of tariffs, you would tariff imports at rates that are sufficiently high to actually make it more economic to produce more in the United States. So this is a way to boost US manufacturing employment, reverse some of the geographic disparities and prosperity and mortality that have been observed in recent decades. Certainly it would mean higher consumer prices, but again, those higher prices would then incent more domestic economic activity, productive capacity, of course, potentially also increasing foreign direct investment as foreign corporations invest more in the United States to serve the US market. But you can see that there's immediate tension between these two uses, because a policy that aims to raise revenue, of course, depends on now imports as a tax base. So to the extent that tariffs generate import substitution, more domestic demand met through domestic production, they won't generate much revenue. So the tariff rates or the tariff policy you would set to achieve maximum reindustrialization would be quite different from those that you would set if your goal is revenue and, again, offsetting the expense associated with extension of those tax cuts from 2017. And then third, there's, of course, also suggestion that tariffs can serve non-economic ends. And we saw that in the period after the election. President Trump proposed 25% tariffs on Canada and Mexico and explicitly linked those to fentanyl and migration. So in this case, the tariffs do not serve to raise revenue, or at least their primary purpose is not to raise revenue. The primary purpose is not to facilitate reindustrialization. The primary purpose is to shape the policies of foreign governments. So again, you have this third element of tariffs being used as a bargaining chip. And so, again, these are all very different. The way that the tariffs are conceptualized will lead to very different outcomes. And I think that this uncertainty regarding the tariff policy, what it means for businesses, what it means to consumers, what it means to supply chains, first and foremost, there has to be this threshold question of what is the goal and how is success going to be measured. But I think the one thing that we can conclude is that the old regime, where trade policy was designed to minimize tariffs, to minimize any cross border frictions in terms of goods, services, is effectively dead. Trade policy that was designed to serve the consumer really lost touch with the interests of the worker. I think that is what we've learned. But, the next 12 months, and again, the decisions about the purposes these tariffs are going to serve is really going to inform us about this new regime that will be birthed in its place. The third question was, will the US election result spur reform in Europe? And I think when you think about Trump's victory and Europe, the implications for Europe, really the first thing most people think about is security issues and the extent to which Europe depends on the US for security. But over the last few years, Europe has grown increasingly dependent on US demand as well. Over the last 4 years, as European exports to China have essentially flatlined, largely due to the sudden emergence of China's domestic auto sector, largely but not exclusively EVs, exports from Europe to the United States have actually increased by over 50%. So now Europe finds itself in a situation where it's not only potentially feeling some insecurity about the US leaving European security for the Europeans, but also potentially imposing tariffs that slow those exports and actually have a further negative effect on a European economy that is already not performing very well domestically. And this, of course, brings us to a report that was commissioned by European Commission President von der Leyen in September of 2023. And she deputized former ECB President Mario Draghi to come up with a report for European competitiveness. And I think in many ways, this report could, over the course of this year, serve as a template for the sorts of reforms that Europe could undertake in response to the US election outcome. And first, I think, and most importantly, as it incorporates both the economy and security, is recommendations for an increase in defense spending. But importantly, this is not simply buying more military equipment or hardware from the United States, as has been the case over the past several years, where 80% of European defense procurement spending is actually sourced from outside of Europe, but actually investing in a domestic European defense industrial base. And so I think this is something that would be significant not only for defense, but also for the economy, the direct impact on industrial production, industrial employment. Also, as we see elsewhere, positive spillovers as relates to cybersecurity, potentially space, also digitalization and AI. Secondly, the reforms really focus on deregulation, but also using the European Union to eliminate duplicative regulations that exist at the state level. Also, of course, changing the orientation of energy policy, recognizing how a decarbonization agenda can actually be counterproductive when it's not wedded with an industrial policy to accelerate some of the investments in new technologies. And I think that for too long, and what's hinted at in the Draghi report, is that the European focus on decarbonization has actually meant divestment rather than new investment, which is to say that by curtailing investment in carbon energy, that the goals could be achieved. But of course, that simply reducing investment in carbon energy or acquisition of carbon energy, also after Russia's invasion of Ukraine and the disruption of those energy supplies, has resulted in a 3 to 5 times greater cost of electricity and broader energy in Europe than the United States, which has dramatically eroded the competitiveness of European industrial sector. So, we'll see what happens with the Draghi reforms, the appetite for change, both in Brussels and European capitals. But I think that there does seem to be some ferment. We will see the results of the federal elections in Germany in February. This will, I think, provide an early glimpse of the electorate's appetite for change, or perhaps alert policymakers to some of the unwanted changes that could be in store if reforms aren't undertaken. And I would just note that even if one is not optimistic about the scale of changes, when you look at relative prices, you look at relative valuations, European stock indexes have forward price to earnings ratios that are about 40% below US levels. When you adjust for sectoral composition of those indexes, it's still 25 to 30% cheaper in the United States. So there is the sense that low valuations do create attractive entry points and provide some compensation for the risk that change does not materialize on the desired scale. But it will be interesting to watch over the course of the year. The fourth question we asked, will big tech's data center investments pay off? So again, over the last 2 years, US economic growth, it's been fascinating to watch how a relatively small share of the economy, our estimates about just over 4% of GDP, have accounted for nearly 40% of the growth over that period. And this category we could describe as fixed industrial investment. So largely this is construction activity, construction of renewable generation capacity, investments in the electric grid, factories for battery storage, for electric vehicles. But especially, we've seen this enormous growth in investments in data centers. Data center investment up eightfold since the onset of the pandemic. And so this is investments in hardware like GPUs, of course, the infrastructure, the physical infrastructure, and then the related applications. And much of this investment has occurred, of course, through these very large AI hyperscalers. So NVIDIA's top four domestic US customers for those GPUs have combined to increase their capital budgets by an astonishing 90% over the last 2 years. I mean, that growth is, really extraordinary on its own terms. But given how large these companies are, this has also resulted in about a sevenfold increase in these companies' capital budgets as a share of US GDP over the last decade. And so the question, I think, going forward is whether these investments are going to pay off. Because what we've seen over the past few years is, I think, a subtle change in business strategy. For many years, these large companies have really been, you could say they were virtual businesses. And they've commanded such very high multiples in terms of their price to book value, precisely because you wouldn't think that their valuation should be in any way anchored to the value of their physical assets. Their physical assets account for a very small share of their earnings potential, which mostly comes from intangible assets. And that is, proprietary technology, the brand, the user base, the path dependence associated with that. But now you've seen, again, this change where instead of just generating cash, sending that cash back to investors in the form of dividends, special dividends, especially stock repurchases, a larger and larger share of that operating cash flow is now getting reinvested in the business. And just as an example, if you were to go back to the first quarter of 2016, it was typical for these businesses. They could generate so much cash that they couldn't replace their entire fixed capital stock from operating cash in as little as 10 months. Today, that's actually closer to about 2 years. So again, it just gives a sense of the value of that installed capital base relative to their cash flow. But yet, even as these companies have transitioned from those virtual businesses to a more capital heavy or capital intense model, we've not seen any decline in those price to book value ratios. In fact, price to book values have actually risen, both in absolute terms and in relation to the rest of the market. So this subtle change of strategy, for it to pay off both for the economy, given how much US GDP has grown dependent on this capital spending, but also for investors, these capital investments better pay off in a big way. And as yet, one does not see the downstream revenues, the downstream applications that are necessary to justify capital spending on this scale, or at least generate the rates of return on capital that would compensate investors for otherwise being able to receive those dividends in cash or the share repurchases or those distributions today. And that actually leads us to the fifth question, which is, and what could these data center investments and their success mean for the future of software? So, over the course of 2024, as these capital budgets kept getting larger and larger, a number of stock analysts at the quarterly earnings calls would start to ask tougher and tougher questions about, again, precisely where are the revenues going to come from to justify all of this spending, to earn the rates of return on this incremental capital that's consistent with the rates of return that's been earned on, as a largely virtual businesses previously. And at first, I think many of the management teams didn't really offer concrete answers. For the most part, it was the suggestion that the AI technology is really going to be so transformative that the risk of underinvesting here is far greater than the risk of overinvestment. And I think that worked for a while, but again, as the budgets went higher, there was more scrutiny. And finally, in a podcast that was released just before the end of 2024, Microsoft's CEO suggested that AI ultimately would replace conventional enterprise software, including software as service. And according to the way that he conceives it, traditional business applications, traditional enterprise software could become obsolete as the AI agents effectively automate and directly interact with databases, performing the complex business logic that currently depends on coding and related maintenance, essentially replacing that human intermediation and coding with AI agents to do all of that work. And we'll see what happens, whether this occurs in 2025, that we see things move in that direction. But I found this interesting to take aim at enterprise software because this is a part of the market that has had a bit of a rough time of late. And enterprise software, if you look back, really the period prior to the pandemic, but especially through 2021, this was probably the most attractive place to invest, both in public and private markets. And a lot of that had to do with the realization that the traditional valuation metrics didn't make much sense when applied to this space. Because these businesses, cloud-based software, incurred almost all of their costs up front, just the programming expense, development costs. And that meant that they could scale revenue with virtually no incremental hiring, investment, or distribution costs. It's just effectively the zero marginal cost, where once the development costs were recovered, the revenue associated with each additional user or each additional subscriber for the software as service falls directly to the bottom line. And that scale property meant that, again, to treat the valuation of an enterprise software business with like a traditional industrial didn't make any sense. And so valuations really skyrocketed as people, again, became more understanding of these scale properties. But I think that we learned two things over the past couple of years. The first is just how sensitized this basic cash flow arrangement is to interest rates. Because effectively what you're doing is trading upfront losses, again, these development expenses, for profits that can be out in the distant future, maybe 5, 10 years into the future. And of course, when interest rates are zero, real interest rates are negative, this sort of trade-off is very attractive. There's not really any opportunity cost associated with funding losses today. And then when long-term bond yields are very low, that means that the present value of those future profits are worth much more in today's terms. But once rates increase, all of a sudden the situation changes. The funding losses today stings. It has a real opportunity cost associated with it when you can earn 2% or more real returns in cash. And then, of course, the same way with that terminal value or those profits in the distant future, they become worth less as bond yields rise. And then now, I think with this potential that AI and the AI hyperscalers focusing on the enterprise software, cloud-based software revenues and those gross profits, you now have a realization also that these intangible assets that create these incredibly attractive scale properties also are a bit of a double-edged sword because they also have very unpredictable depreciation rates. When you think about business equipment structures, logistics networks, or platforms, yes, these are constraints on your growth in traditional business sectors, but they also tend to depreciate at relatively predictable rates. Software or other intangible assets can suffer sudden and really unforeseen declines in value. And so, again, this is another element of this that perhaps investors weren't as attuned to when it was focused on more of the upside, the scale properties, and the upside. So, we'll see what happens here. It's going to be very interesting over the course of 2025 to see how this develops. But it seems to me that this is something where it's a very useful, very helpful injection of risk aversion into a market where people had not really been as attentive to risks in the past. So to me, the more likely outcome could be that by pushing valuation ratios back well below pre-pandemic levels, this risk of AI disintermediation could actually create some attractive investment opportunities in a part of the market, enterprise software and broader services and digital applications, that had become less attractive in recent years simply because of all the attention and capital that it attracted. So those are our 5 questions for 2025. Again, we look very forward to evaluating them and trying to get some answers over the course of the year. As always, thanks for listening, and I hope you'll join us for next month's episode of Insights and Indicators. We'll return to our normal format with a guest. Thank you very much.